What is going on, investors? Time to kick off earnings season. We're going to start today with JP Morgan, ticker symbol JPM. If you're not familiar with this channel, whenever major companies report earnings, we jump into kind of the press releases, we jump into the earnings, we take a look at the numbers, we dissect all that, and then finally we jump over to the chart to see if there's a place where we can go long this stock. So we'll start today with JP Morgan. This is one of the largest banks in the world. They have a dividend yield of 3.5%. But what I want to make you aware of, if you're not aware of this already, are all these banks have to put a pause on their dividend and the share buybacks at least until the end of the year. The Fed chair is not allowing these banks like Wells Fargo and Citigroup and Bank of America, they're not allowed to raise this dividend until the end of the year. Now, that is not great news in the short run. In the long term, it's probably okay. These companies might end up doing a larger, maybe a special dividend or maybe a larger than expected raise when they're allowed to do that, and maybe a reissuance of the buyback might help spur the growth on these shares in the future. But as you see in the last 6 months, we're literally dead flat with JP Morgan Chase shares. So it might put a lid on the shares in the short run. We've got a $300 billion market cap on this one. Now, again, this company just reported earnings today. Some interesting tidbits from the press releases and the conference call is JP Morgan said they're over provisioned on the loan credit losses. So all these companies, if you're not familiar with banks, is they have to put money aside for if you don't pay your credit card or your mortgage or whatever loan they have extended to you. If you don't have it paid, well, these companies are required to have some provisions or loan loss or credit loss provisions. And JP Morgan says they are over provisioned by 10 billion. So that's a good sign. But wait, he says, but could be under provisioned by 20 billion if there is a double dip recession. That comes straight from Jamie Dimon. So the major credit losses aren't going to be recognized and realized until 2021. And until then, provisions will flatten out until those real losses go up next year. So that, I think, has kind of put a damper on the stock a little bit. You actually see the stock trading down about 1% today. Investors are not super excited about this loan loss provision kind of, not only maybe not being enough by about $10 billion, but we're not actually going to see the impact of it until next year. So we're not sure if it's going to be under by 10 billion, and we're not even sure if that's going to be the case until next year. So a lot of question marks going into next year for JP Morgan. Now, really quick, I just want to jump into a valuation kind of analysis of JP Morgan. I think if you want to analyze bank stocks, I'm not big always on PE ratios or price to sales or all this, especially when you're comparing company to company. But if you want to compare a company to itself, it's not a bad idea. Also with banks, since their business model is relatively similar to one another, comparing the book value, the tangible book value in this case, is not a bad idea, because banks, if you're going to pick a metric to analyze a bank, either book value or tangible book value, this is if the company had to liquidate their entire portfolio and all they had left with either some assets or some liabilities, this is what they would be left with. We see here, this is a max chart of JP Morgan's price to tangible book value. So this goes back, over 20 years now. And we see here, we're right at the 1.68 tangible price to tangible book. We see this stock, it's gotten down to like that one level. Obviously, we'd love to come back here, but we haven't seen that since the great financial crisis back in 2009 and 2011 and 2012. We hit this one mark. Now we're kind of halfway in between it. I like that spot with JP Morgan. If it comes back a little bit more, I think you're getting pretty good value. We saw it earlier this year when we had the big dip in shares back in March and April, down at the 1.4. I think if you can snag this at 1.4 to 1.5 tangible price to tangible book, you're getting pretty good value on your JP Morgan shares. Now, jumping over to their financial results, a little bit different. When we jump into the numbers, it's a little bit different how they present these. It's actually a little confusing. So So I'll try to make it as clear as possible. Now, just right off the top, JP Morgan earned $9.4 billion of net income on nearly $30 billion of revenue. Wow, that's really nice. You know what I mean? To earn $9.4 billion, net out $9.4 billion on $30 billion of revenue. Those are some strong margins on banking revenue. So that they're doing a great job in a low interest rate environment. Some of the lowest interest rates the lowest interest rates we've ever seen in the world here in the United States. And they're churning off $9.4 billion off $30 billion of net revenue. That's really good. Some interesting things. So we've got this consumer banking. Average deposits are up 28%. Average loans are down 7%. Credit card sales volume is down 8%. What is this showing? More broadly, what this is showing me is consumers are parking money, saving money, and they're putting less on their credit cards and their loans. They're taking less loans out. Okay, in general, in a vacuum, that's not a bad thing. Consumers are, they're feeling the pandemic. They're not confident about the future. But for a broader economy that relies on debt and loans and people spending money, this is not necessarily a good thing. So we'll see more broadly whether or not this has any impact on our economy or not. Now, here's the consumer banking. JP Morgan really has 2 to 3 big divisions. They have a few more than that. As you see here, these are all their divisions. But as we get down here, these are a little bit smaller in terms of what they contribute to the company. The biggest division is this consumer and community banking CCB division. We see net revenues here came in at $12.75 billion. That compares relatively favorably to the previous quarter here. This was right in the middle of when things were going bad here in terms of the virus here in this country. And we see comparing to this time last year when things were all great, we're obviously not back to that point yet, but we're getting there. It's not too bad. Consumer and business banking, we see is again compares nicely to the previous quarter. We're not seeing a deterioration quarter over quarter. And I think that's a good sign if you're long this bank or if you're long kind of the consumer banking sector. Home lending, actually relatively flat, in an environment where homes are increasing in values in a lot of the big markets and a lot of the suburbs and things like that. We're not actually seeing home lending go up. So it'd be interesting to see if this flatten turns negative. I actually seen some data that predicts that happening. Again, we're talking more macro here, but that's the kind of stuff you get when you look into JP Morgan. You not only can draw conclusions into JP Morgan, but you can draw conclusions to like the macro environment. And if we see home loans and home lending turn negative at some point, or even just flatten out, it's not necessarily a good sign for the broader economy. Now, we've got cards and auto. This is credit cards and auto loans. We see a down actually a quarter over quarter, and we're down year over year. So people are spending less on their credit cards and they're buying less cars, or they're not paying as much for them, whatever it is. So that's not that great, but we see not interest expense that actually ticked up a little bit, and it's marginally off this time last year. So they're still squeezing that non-interest expense out of the customers. Gotta love that if you're a shareholder. Provisions for credit losses came down a little bit. Again, they boosted way up here back in Q2 when things were a little bit uncertain, got a little bit more back to normal. So that's good. But again, remember what the banking executive said is we're not going to see the full effects of that until next year. Now I've flipped over to corporate and investment bank. That's CIB. That's what they, give it a little acronym for. We've got net income or net revenue, here at 11.5, down considerably actually quarter over quarter, but we're actually up from Q3 of last year. So that's solid. We've got banking revenue here, again, up over the last year, but down quarter over quarter. So it'll be interesting to see if Q2 was simply just an anomaly, or we're just going to focus on the 19 over 20 numbers, which appear to be very nice. These markets and market insecurities, look how much that inflated here. We had tons of banking and corporate and investment banking activity right here. When things were uncertain, companies and corporations valuations, were unsure what was going on, they did a ton of like borrowing money, issuing bonds, things like that. And so there was a ton of those fees generated. Now we've seen a little bit more normalized environment here in Q3, but it's nice over Q3 in 2019. Non-interest expense comes in really nicely. Again, lower than Q2, but higher than Q3 in the previous period. Net income, really solid, 4.3 billion. Take a look. We were at 2.8 billion. They are generating those fees over in the corporate and investment banking. Now, finally, commercial banking. This will be the last one we look at. The other segments of JP Morgan are pretty small net in comparison to these. I mean, it's a big business, but it's small in comparison. So we've got 2.2 billion in this commercial banking. Again, this is a very, look how consistent this business is. Non-interest expense, very, very consistent here. And then we've got these provisions for credit losses. So it ballooned. Look how much it ballooned here in Q2. And then it came down here and it was more normalized here. And so we see net income was really impacted in this division last quarter, but now we're back up to $1 billion and it compares favorably here. Really consistent here. And so that's a good sign for shareholders. Now, finally, jumping over the chart, JP Morgan is in a short-term uptrend. We bottomed out here back in 925. And so we bottomed out here and come up. So we've done this a few times. We've kind of bottomed out, waved up, bottomed, waved up, kind of bottomed down here and then waved up. We're in a short-term uptrend. We're above this light kind of Carolina blue line here is a 50-day moving average. You see here that the stock likes to kind of just wave around this. And, this line, acted as support here. It was a little bit of support here, a little bit of resistance, popped up, came back down. Now, if you want to go long JP Morgan in the short term, I think this short-term uptrend is intact because you see here today we're stopping right on it. Okay, right on earnings, right when we get the numbers from JP, the stock just paused right here. So it'll be an interesting spot. We're aware that this company is not going to raise its dividend. They're not going to raise its buyback. This is an interesting spot for a much longer term investor. I wouldn't, try to pinch pennies here. I think you're getting a good price from a valuation and from a technical perspective. This is not bad. If you really want to pinch out of this one, we see the 50-day moving average is closer to 100. If the stock pulls back down in here, it probably will pause down here, but we will have broken this kind of short-term trend, and it's likely that we might fill this gap. See, we have this gap here. There's this gap down in JP Morgan. I could see this anywhere between 96 and 97 being even more interesting if you really want to squeeze it. For example, I'm long JP Morgan already, so I like to, when I'm already long a stock, when I add to it, I like to really get it at the best price. So this could be an interesting spot as well. So JP Morgan, like what I'm seeing here on the chart, at least in a shorter to intermediate perspective, I think what's going to happen is, I don't know, it's anybody's guess. Are they going to be allowed to raise their dividend in Q1 of 2021? I don't know. We might have a completely new Fed chief at that point. You never know. Government's going to potentially change over here in the next 3 to 6 months. And so you don't know what kind of changes that's going to bring into the banking sector. I think that is why for the last 6 months, these stocks have literally been in a sideways pattern. And since the big fall that we saw back in March and early April, this stock, as you see, has been kind of in a flat kind of holding period of time. So that is not bad for accumulation. If you want to accumulate JP Morgan, I think better days are ahead. Dividend will rise. They'll be able to do some buybacks as well, like this stock. Again, I am along this stock as well. So there we go. Stay tuned for more videos. We'll be having a bunch of them this week, next week, for the next month or so. We'll be covering them all. So thanks for tuning in. Good luck with your investments.